measurement of divisionalized. Anyone? Divisionalized system. The first measurement is the use of RoCE. Let me write it fully. Return. Return on what? Capital employed. And this is CE. This is a measure of profitability. This is a measure. This is a measure of profitability of a business in relation to the capital invested in the business. Capital invested in the capital invested. And RoCE equals to profit before interest and tax divided by capital employed multiplied by 100 all over 1. Where PBIT equals to profit before interest and tax, and CE equals to capital employed. And capital employed, how do I get that? Is my total asset minus current liability. Okay. RoCE we said is the measure of what? Are we too fast? Okay, please, as we move on, there may be tendencies that I will start making too much assumption or maybe I'm too fast, right? Unknowingly. In that case, what will we do, guys? So this is the first one, RoCE. Okay, so this RoCE, right? You can also look at it as ROI, ROI, and I'll explain the difference to us. We said it's what? Profit before interest, right? Remember, who are we appraising here? Let me ask. Who are we trying to appraise? Yeah, the profit center manager or the divisional, the divisional design official. Exactly. So who is appraising them? The head office is appraising them. Why are they appraising them? Because remember, I told us yesterday that there's a balance sheet, there's a profit budget, for the head office. Then you have the total revenue, total costs, all those other things, and then you have projected profit, and then you now have all these divisionalized centers that revenue, maybe 20,000 is coming from you, 10,000 is coming from all of them, will sum up to that total that you have in the end. And so at the end of the period, every division has their own budget of profit, budget of revenue, budget of cost. At the end of the period, every division is going to be held accountable for how much of this budget they will be able to actually bring down. Because there's always what? There's always variance. Variance different between what you have projected and what? And the actual thing has happened. That's the variance. Right? Now, if you must appraise a divisional budget, the center, should you use a controllable profit or non-controllable profit? Let me explain. If you say you send your child to school and it's not doing well, you start following the child with it. What do you investigate? You investigate what? Why are you investigating? Exactly. So you want to know why the child is not doing well. Could it be that your expectations are too high? Could it be that the school is not teaching them the right thing? Could it be that the syllabus is too bulky and all of that? After the release of every exam, we go back to look at the pass rate. Oh, pass rate for peer let's say it's 32. Their budget is 45. What happened? Could it be that students are no longer reading? Could it be that the examiner, the standard was too high, so they go back to correct? Is either you are trying to adjust that marking scheme or try to adjust, whatever thing. So basically, everything that we do here, we are looking at, we try to manage or to appraise a divisional manager. You must use what you call a controllable profit. Now, what is that controllable profit? It is the profit before interest and tax. Now, let me take this note here, NP. Profit before interest and tax is used because the divisional manager should only be held accountable for the portion of profit that is within their control. So PBIT, we are saying, is controllable and traceable. There was this question also that they said, and before the following, controllable profit, traceable profit. When you talk of a controllable profit, what does it mean? That's simply saying that you have a control over that profit. Am I correct? When you say it's traceable, what does it mean? It means that that profit can actually be traced to your division. Is that not? Can be traced to your division. Controllable means that it's within your control. Now look at the profit before interest and tax. This is profit. What is this? Interest, I mean. Interest is within the control of the manager. Why? Interest. Eh? Why is it within the control of the manager? And why? Why? You say no, why? Tell me. Why? Why? The interest rate is set by the person giving you the money now. Yes. So I'm talking of from the perspective of the organization now. Do you think the manager has control over interest? Okay, now what I'm trying to say here, look at it. If you are a manager in Kubwa branch or in Wuse branch, can you walk into any bank and say, because they have given me autonomy, they are operating and walk into any bank and say that? Is it possible? No, it's not possible. Why? You cannot, because when you talk of loan, it is a strategic decision. Strategic decisions are made by who? Head office. So what that simply means is that if you are having any interest element here, if the decision is coming from head office, it means that that cost should be with the head office at the end of the day. And so you shouldn't use that interest expense, charge it to my profit to use it to appraise it, because it's not within my profit. Do you understand that? Yes. Huh? Yes. Yes. I listed on. Yes. Yes. Mm-hmm. Okay, no, I think you're missing it. Subsidiary structure is different from the structure you are talking about here, right? When you talk of subsidiary, you are simply saying that your company has an interest in another company. That's subsidiary now. That's a different thing. That structure, you are only consolidating at the end of the day. It's a different thing. But here we are saying we are all the same, but we are saying that because we have different, customers everywhere, we are saying Enugu, okay, have a division. Calabar, have a division. Uyo, have a division. And then you put so still the same one now. So in this decentralization, you don't consolidate. In subsidiary, you consolidate. Right? So they are not the same, right? So we discussed interest. The next one is tax, right? Tax also, is this central? Is it centrally? Is it a central decision or divisional decision? Tax is a central decision. And so anytime you're trying to appraise a divisional manager, what profit do you use, guys? Profit before what? Interest and what? Don't forget. What profit do you use?
Profit before interest and tax.
You will be sentenced to give you profit after. When you give you profit after tax and you want to appraise the divisional manager, what are you supposed to do? Have that. Right? Simple. Are we together? All right, let's move on. Yes. Yes. Mm-hmm. Yes.
So how do you reconcile that out?
On tax. Okay, so if you have what you're talking about is specific to only the now where you have what you call the relevant cost, and we'll get to that. Right? If you are in Enugu, and because you are in Enugu, there's a particular kind of revenue that you enjoy. Is it going to be a decision? Is it going to come to you if you are in Enugu? And only you, if you are in Enugu, right? You have another person in Calabar, another division, and there's a particular revenue that's coming from Enugu. Will you enjoy it? Only you that will enjoy it. So also, if you have a particular expense that is coming solely for Enugu, they charge it to you. So in the case of Lagos, because Lagos is different, it's not central. Because it's not the entire country that are looking at, they are just looking at your own division, and you're saying this is a divisional tax charged to you. All right. So we've also talked about traceable. So let's look at advantages and disadvantages. Advantages of RoCE. RoCE. Number one, it is easy to compute and understand. So students will write, it is easy to compute, it is easy to interpret, it is easy to understand. They are all 1 point. All right. You just want to make your book to be full. Okay, so easy to compute and understand. Number two, it is linked to shareholders' wealth. Shareholders' wealth, because it uses profit figure. Number three, RoCE is one of the most important profit metric which is linked to overall business objective. What is overall business objective? Maximize profit. All right. What are the disadvantages? Disadvantages, number one, profit figure is subject to manipulation. That is, can be window dress and also creative accounting. What's the difference between the two? Or can we assume that they are the same and move on? What's the difference between window dressing and creative accounting? They are the same, I mean. I was thinking of it. They are similar, they are the same. Politicians. They are not the same. When you are trying to window dress, you are creative. You are padding. Are they the same? Are they the same? When you say they are similar, is that you are being political. The creative. Are they the same? Are they the same? Are they the same or they are similar? They are the same. Okay. Tax evasion and tax avoidance. Are they the same? So why is that one that obvious to you? One is criminal. One is something. So basically, just like you have tax avoidance and tax. So when you talk of window dressing, something is bad. You want to make it look good. You want somebody that's standing from the window to look at the room that is so fine. You put blue light, you sweep all the dirt under the carpet. Because the person is not entering inside. It's from where? It's from the window now. When you go to a boutique, what kind of light do you put there? Why don't they put this kind of light in the boutique? I do wonder. They put all those white. I just try to make you buy a faded shirt. In the under that light, you're looking so fine. Right? But when you talk of creative accounting is simply just sorry. Hello? 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 I'm in the class. Okay. Okay, so when you talk of creative accounting, you're just using advantages, loopholes in the standard to achieve what you want. It is not criminal. There is no law anywhere that is saying that you cannot do it. For instance, that provision, you know that you are waiting it back. You did that you not see. You are waiting till January, so that from January, when you write that provision back, what happens to your profit? It will start growing immediately. I mean, no law is saying you should not do that. When you talk of window dressing, somebody uses the word padding. Padding, reduction, you are trying to just do carpentry on the account just to make it to achieve what you want. So they are not the same, basically. And so we're saying if you're using profit as a measure, one of the problems is that because the people that are managing this division, they are managers, I mean. If they are managers, they are qualified managers, so to speak. If they are qualified, it means that they know what to do to achieve whatever profit they want. I mean, by going into window dressing and also. And so that's one of the major problems with this process. Which one? This one? Yes. Engineering, carpentry. This one, this window dressing has plenty names. Padding also is there. But this creative is just creative. You're just padding. I know the class. All right, so basically, let's move on. Number two, the use of RoCE discourages divisional managers from investing in long-term assets. I will explain that. Number three, RoCE uses capital employed, which has different meaning to different entity. This will hinder comparability of results. Demand right is getting better. Okay. So the use of RoCE discourages managers. Now let me, are we done writing here? I can move it. Let me move the screen. We said RoCE equals to EBIT divided by capital employed. Is that multiplied by 100 over 1? This is how you calculate RoCE. Now, if I'm making more revenue, which of these parameters will be affected? If my revenue is increasing, which of these parameters will be affected? Profit, this will be going up. If my cost is reducing, which one will be affected? Profit, are you sure? Okay. How about investment? If I invest, which of these parameters will be affected? Capital. Exactly. Now look at this now. We are saying that the use of RoCE discourages managers from investing in long-term assets. If I have company A and B, and then their profit before interest and tax, let's say they have the same size. This is 500,000. This is also 500,000. And then I have their, let's say their asset. Asset here is 2 million. Asset here is also 2 million. Same size. And then you have their liability. Current liability, this guy is 500. And this is also 500. Can I compute RoCE from this information? Guys, what is RoCE for company A? No hiding place. Figure. No window dressing, no padding. Figure. You know but or you let that. Oh yeah. What's going on now? Calculators not working. Madam, figure. 130. What did you get? 33%. Look at this. They both have how many percent? 33%. Let's say their target RoCE is 20%. Have they both done well? If their target is there a problem with anybody? No, now. Divided by this minus this now. Capital employed. In the exam, you know this one they will give to you. They will give you a balance sheet, maybe. You see total, you see asset, under asset, you see non-current asset, current asset, blah, all those blah blah blah. Just go to the total asset, go to the liability portion and pick only the current liability. Let it off from the total asset to give you capital employed. Are we good? All right. So now, assuming that this company have a target RoCE of 20%, are they both done well? These two companies, they are both done well, have you? Now, assuming now that we now have investment. Investment opportunity. The guy A here, company A is saying that I want to invest in this, and he's saying the investment is, let's say, 1,500,000. And company B is saying, no, I don't want to invest here. Let me do it. Now look at this. There's always a time lag between when you invest and when the return comes. True or false? So for the first few years, it's possible that this extra investment will not generate as much as return as it should. True or false? So it means that your return for that early period, what will happen? It's actually be reducing. Now, if I'm recalculating this RoCE, look at. If I want to recalculate this RoCE for this guy, remember, their profit is still constant, 500,000. Divided by capital employed now, what would that be? Asset to increase how many percent? How much? 1.5. So I have a total of how much now? 3.5. Take away current liability. You have 3 million, right? So I have 3 million. Times 100 over 1. This guy will still have the same thing. True or false? 33%. Nothing is changing, right? So what is this? How much is the RoCE? 16%.
16.7.
No. So what has happened?
16.7.
If you are asked, if you see these two report cards, who do you think is doing well? 33% is doing well. Who will get the bonus? 33% because their target, let's say, is 20%. This guy will get the bonus. Will this guy get the bonus? No. But in real sense, who is actually doing something in the interest of the company? So basically, because managers are short-term, there's a term that's short-termism, right? Short-term is a term that is used to refer to focus of managers on short-term benefit, remuneration, profit, right? So now, if you were using RoCE, managers will be discouraged. Like this manager now, what is he doing? Why do you think he's not investing in this? Because they're aware that the moment I invest in this opportunity, what happens to my capital employed? It will go up. And if I don't get a corresponding increase in revenue, what will happen to RoCE? My RoCE will fall. And so basically, the use of RoCE, one of the disadvantages is the fact that managers will always be what? Discouraged. Look at, discouraged from investing in long-term assets. And this will always bring up a conflict of interest between who and who? Between managers and what? And owners of the firm. Owners. Managers are fixated on what can I get now? When I go to increase our salary. By the time you qualify now, the next thing you're doing is to go. First thing you go and update. In fact, some people from professional, they're already updating their CV. What are you trying to do? You want to do another job. Why? Why? You don't have players again. You want to move to another because all you are fixated on is what? Just benefit. It's not, is it my father's business? Have you heard that before in your office? Is it my father's work? But at the end of the day, all that we want as professionals is what? Money, money. Which one is paying us more? If this is paying me more, no bond, I move. You know. So at the end of the day, so there's always a conflict of interest between the owners of the firm and the manager. And last one, we say RoCE uses the concept of capital employed, which means different things. Right? Some person, we just said that capital employed is total asset minus what? Current liability. Some other entities will say their own is net asset. Net asset is total asset minus total liability. Some will say their own is total asset at the end of the day, or the capital invested. So anytime you are using capital employed as any appraisal method, it always leads to conflict of the what's it called? Always brings about difference in your result because of this definition of capital employed. And if there are difference in the parameters you are using, basically comparability becomes a problem. It means you can't compare two companies of the same size, right? Yes. Less cash. Okay, I will explain. When you see cash, right? The concept of cash and land, they are related to controllability and traceability of investment, right? So remember, we are looking at controllable property. When you talk of controllability, there are instances where division may not have control over cash. So anytime a division is not having a control over cash, it means if I want to appraise that division, it means whatever cash I have, I should take it out of their capital. The same is investment in land. Investment in land is a strategic, decision. You can't say because you are the manager of Kuwa, manager of Wuse 2, you go and buy land on behalf of the company. Is it possible? No. So anytime you see a land in such balance sheet, what do? You deduct that land from the capital employed because it's central. That's why. So that concept is closely related to when you have traceability and controllability. And there's a question we'll look at like that also, where you have to deduct cash, where you have to deduct some, non-controllable profit because you complete RoCE. All right. Okay, so the second, we talked about RoCE, we talked about the advantages and also disadvantages. You can make up these notes from the smart note I'll be sharing with you much later today. At least make it up in 5 times, just in case you're lucky to come across this. Just no thinking. You can be able to spell out 5 points for advantages and disadvantages of this. So the second appraisal technique is what you call the residual income. Residual income. The word residual relate to what? What does it mean? Huh? Yes. Residual income is the profit of an entity or division remaining after deducting imputed costs. Imputed costs. And imputed cost is simply cost of raising funds. All right. And residual income equals to, again, profit before interest and tax minus capital employed multiplied by work, where PBIT equals to, as it is your note, profit before interest and tax. CE, same thing, capital employed. How do you calculate capital employed? Ideal calculation of capital employed. How do you do it?
Total assets minus current liability.
Are you sure? I was testing. Okay. And so you have weighted average cost of capital. Weighted average cost of capital. And work at this level is calculated by multiplying KE by the value of equity over VO plus KD multiplied by the value of debt over VO into 1 minus T. No thinking. Where KE equals to cost of equity. VE is value of equity. KD, cost of debt. You're doing well. You're ready for this exam. VD, value of debt. And then our VO is value of organization. Which is VE plus what? VO. And our T equals to tax rate. Yes, sir. Plus VD. Sorry. Plus VD. All right, can we proceed? Yes. Yeah. Just like this now, divide by 1 over 1, but I don't need just upgrade, raise the power. No. Multiply by whatever thing you get, multiply by 1 minus. Say again? Yes, because the interest, interest is related to debt. Okay. What is the difference between value of equity and cost of equity? Okay. Let me quickly show us something. Any issue? Kill corner. Now, look at a balance sheet. I'm sure we all understand what the balance sheet is. Everyone, right? Now, your balance sheet has two sides. You have assets part, right? And you have the liability part. Under this asset, you have two kinds, right? Non-current asset. I mean, let's say this non-current asset is 200,000. You have a current asset. Let's say current asset is 300,000. My total asset is what? 500,000. Then you have a part that is called the finance buy. Finance buy simply means that how are you getting money to do this business? Is that also? Now, the finance bank, the first part of finance buy is the equity. Equity simply means contributions of owners of business, people that are investing, that are bringing money to invest, right? So let's say that equity has, let's say, 150,000. Then you now have liability. And again, liability has non-current liability and what? Current liability. Let's say current liability is 50. And this is 300. Total equity and liability, how much? 500,000. Now, in the exam, for those doing FR, you will be wondering why everything in a consolidated account, you will be doing everything sweating, so that total asset will be equal to what? This total equity and what? And liability. Why? Because this finance buy is simply saying this is how you're raising money to do the business. If I raise 500,000 to do a business, it simply means that the value of that 500 is seen in the total value of my asset. I will use that 500, part of it I'll buy non-current liability, part of it I'll buy current liability. And so the total money I've raised should equal to the total asset. If at any point this amount 500 I have here, what I have here is now 400. What do you think can happen? Eh? If I raise 500 and asset is 400, what has happened? What did you do with the 100? You spent it. Capture what? If you account it to be under current asset now, you have not even used to buy anything to be cash. Cash will be under current asset. So it will be here. So if you have raised 500 and your total asset is 400, you have spent 500. You don't use it for the business. What they call drawing in accounting. Use it to buy the thing. On the other hand, if your asset is 500,000 and then this guy is 400, what do you think has happened? That you are not registered. You got money from somewhere, maybe they pay you your salary. You use that money, use it to buy inventory. And then here is now short, but your asset has actually increased. And that's one of the problems we have with all these small businesses. Because you have maybe another business, or you have a salary. When you collect your salary, you use it to go and buy. In your mind, that your business is generating so much cash flow. Until you are able to separate your business from your personal, you will not be able to know the financial standing of that business. Now, going back to your question. Now, the work we are talking about here, we have raised a total of 500. This 500, remember, these people are equity holders. I mean, people that invested equity in our business. And these people are debt holders. People that gave us money, the likes of bond, they gave us money and they're expecting a fixed interest as their return. Am I correct? I'm paying interest on this every day. And this interest I'm paying now is simply because of debt. You understand that? If I go to the bank to collect 300,000 and they say the interest rate is 6%, that interest is simply the cost of raising that 600,000. On the other hand, if somebody invests equity in my business, what am I paying the person? Dividend. Somebody who invested equity in my business, I pay dividend. How do I pay dividend? After every year, I calculate the profit after tax, ascertain the payout. Payout is the proportion of my profit after tax I'm willing to pay out to them. Whatever dividend I'm paying now represents a cost to me. And that dividend I'm paying now is simply what? It's simply the cost, like the cost of equity. And so when you talk of what, we are saying we want to get a singular cost that represents the cost of raising this 500. In that case, what we are saying here, let's say that cost of equity, KE, let's say is 8%. And let's say our cost of debt, KD, equals to, let's say, 5%. What we are saying here is that as far as this cost of capital is concerned, if I want to calculate WACC here, this equity here is the value of equity, the value in Naira that they're having with me. So I would have 8% multiplied by, what is the value of equity? What's the value? Look at the value now. The amount, 150,000, right? So 150,000 divided by what? VO. What is the value of the organization? 500. It's just proportional. We are weighting them. So this is 500. And if I come to the debt part, what will I be doing? I will say 5% multiplied by what? This 2 is how much? 350 divided by what? 500. That's what we are saying. But even at this level, you don't even have to bother yourself. In the exam, what they will give to you, your examiner will tell you what the cost of equity is. Your examiner will give you cost of equity. You see this VE over DO, right? Is the proportion. They call it capital structure. Capital structure is simply saying what percentage does equity. I'm talking too much, I do. Just calm down. All right. So, but like I said, that illustration I did for you, forget it. Let's assume that we never do that one. Focus on what I'm saying now. In the exam, see what you see. They will give you KA. Is this a problem? They give it to you. Thank you. This VE over VO, they won't separate it. Instead, they will just give you a capital structure. They say capital structure is 50% equity, 50% debt. Does that make sense? It means what I'm having here is just 50%. Because it represents for equity. Are we following? If I come here, VE over VO is capital structure for debt. So if this one is 50%, automatically debt will be how many percent? If this one is 30, this one will be how much? 70. If this one is 40, this one will be what? Exam also, they will give you this one, KG. Is that the problem? No. they will give you tax rate. At this level, no thinking. And then you're good to go. And then when you're done with it, they give you 1.5 mark. It's not something. Of course, yes. Yeah, 100. Of course, yeah. Yes. So now look at, if EG, follow me. If KE equals to 5%, KD equals to 4%. Please, I know the reason why I'm emphasizing on this, because when we get to EVA, we'll just skip this part. KD is 4%. Capital structure equals to 50% equity, 50% debt, and tax rate equals to 30%. What is WACC? Right? And according to this, our weighted average cost of capital equals to, first, KEAB, 5%, multiplied by what? 50%. Plus, cost of debt is how much? 4%. Multiplied by what? 50%. Multiplied by 1 minus 30%. No thinking, you are done. 1.5 mark for doing nothing. For doing nothing. So what do we have? Punch your calculator figure. So this is 2.5% plus 1.4%. If you do this effectively, you should have 3.9%. Please do it and confirm that you got this figure. What's the final figure? Confirm that you can get 0.039, which is 3.9%. So that means we're good. Yes? Are we good? Okay. If K is 7.5% and KD equals to 5%, capital structure is 40% equity. Tax is 25%. Calculate WACC. Now, you fail it, you buy water for everybody in this class. 1 to 2 minutes, everyone. Let's get a figure. Just fail it first. You need a extra calculator, tell me. Abigail, get your calculator. Yeah. Even you don't have a calculator yet. Okay, even you. Bingo! Madam, Alpha, are you doing it? There's no hiding place, so Yeah, I must see what you are doing. No, you are done. No calculator too. You are still testing the class. Oh, you don't know we'll start calculation. Oh, I told you yesterday that class has started though. People think it's a joke. Okay. You have the figure. Check.
4.5%.
Online, who is talking? I can't call them. What you were following now, what's going on? Yeah. No hiding place. Your work shall be tested on fire. Are you done? You are sitting at the front, though. Are you done? It doesn't matter. Please, everyone, you have to participate, though. You see, the error of coming to class and you say, I will go and learn it at home. It doesn't work. It's from here. Do it now, not at home.
Yes. They're guiding us. Just in there.
Are you done? It's confusing. Hey, was I fast when I was doing this thing? Alpha, you check your figure again. It's good now. You have another figure. It depends on how you want to do it. At the end of the whether you leave everything or you leave just 1%. So in that case, look at it. But we got reduced knowledge. Anybody? Yes. Yeah. We'll just check now. Okay, so let's online. You want me? Okay, so online. Now, please, let's quickly look at this together now. When you're trying to calculate the WACC, all we are just trying to do is we want to get a singular cost that represents the cost of raising that fund. That's why. And from this level, at this level, you are going to be assuming that you have just two kinds of finance, two ways you can raise finance, which is equity and what? And debt. If you're raising money from equity, you're also raising money from debt. You want to get the cost of raising equity and also cost of raising debt. They bring them together in the weighted average form. And that's what this WACC is doing. Now let's quickly compute. Our WACC equals to KE, remember, multiplied by VE over VO. Is that true? Plus KD multiplied by VD over what? VO, then into 1 minus the tax rate. Are we good? What's our KE? 7.5%. Now look at this now. Some persons didn't know how to actually express this, whether to remove all the percentages or leave all the percentages and all of that. Now, smart way to do it is you can decide to leave all your costs in percentage, because at the end of the day, it's WACC, which is the cost of capital you want to get. So if you leave this one as 7.5%, you can express this one in what's it called? Decimal. I don't know if you get. Or convert all of them to decimal so that this will be 0.075. When you are now done, then multiply by 100. Any way you want to approach it is fine. So the approach I want to use is to leave my KE to be in percentage. My cost of equity, cost of debt will be in percentage. In that case, I will have 7.5% multiplied by what? VE over VO. Capital structure of equity is 40%, right? So I will have 0.4. Do you all agree with this? Plus our KD is what? 5% multiplied by automatically VD is 0.6. Then multiply by 1 minus 0.25. Right? So help me, 7.5 times 0.4. 0.0. No, 7.5 times 0.4. That's 3%, Abby? Yes. Plus 5 multiplied by 0.6. Three multiplied by 0.75. This is 0.75, right? This is 1 minus 2. So what do you have? That's 2.5. 5 multiplied by 0.6 multiplied by 0.75. Right? This is 0.75 now. 1 minus 0.25 is 0.75. Any figure? 5 times 0.6 times 0.75 is 2.25. Are you sure? 2.25. Like this? Okay, so percent, and this should give us how much? 5.25%. Was that what you got initially? Okay. Okay. Okay, please go ahead. Three multiplied by 0.75. No. Everything. It's not.
Yeah, and it's like.
Even if you have to use board mass now. But even if you have to use board mass, you can't do that. Right? So if this one, and the truth is, the reason why we are bringing this back is simply because of interest. When you're paying tax, interest and allowable expense of tax. If you take a loan, for instance, a business person, right, and the loan they told you is 60%, effectively, the amount you're paying on that loan is not 6%. Because when you're going to pay tax, you know the interest on that loan before you charge tax. Is that not? So in that case, what you're paying is actually net of this tax. And that's the reason why we're bringing this one on the screen. Are we all clear with this now? This one is the total from debt. Add the two together. Good? Good? All right. Let's see if we can do one small task. Any question? Online. Go smooth.
No questions, sir.
Okay. Yes. Which one? How we got it? This guy multiplied by this guy multiplied by this guy. Yeah. 60%. If equity is 40, debt automatically is 60. Shut up.
7.5%. You use 7.5% and change this from 0.4. After structure. The cost of equity, 7.5%. Times this capital structure.
7.5%.
Yes, sir.
Times capital structure.
40%. You changed this because you converted this to decimal.
Yes, I explained that why I did that. Right? You can decide to convert everything. If you want to convert everything, look at. You didn't get the same thing. Okay, let's do it together. If I'm converting everything, this is 0.075. Okay, multiply by 0.4. Show you plus 0.05 multiply by 0.6 multiply by 0.75. Okay? Oh, this one you multiply, you have 0.03. Correct if I'm wrong. Right? Plus, if you multiply this, everything, you have 0.025. Correct if I'm wrong. That's all now. So if you add the two together, how much is it? This becomes 0.0525. This is what you have, right? If you now multiply it by 100, change it to percent, 1 to 5.2. You have the same thing. Same thing. Okay, Obao.
Sorry, excuse me. Good afternoon.
Good afternoon.
Please, where did 0.6 come from?
Somebody online, please help us.
Okay, sir. Good afternoon.
Good afternoon.
Capital structure is always 100%. So if you've given equity 40%, then 60% should go to debt.
Inugo?
No. Sorry.
Oh yeah, say it again now.
Good afternoon, sir.
Yes, go on.
Okay, in the question, we were given the capital structure 40% equity. So to get the debt, we subtract 40% from 100% to get the cost of.
Okay, thank you.
All right. Okay, so are we all on the group now? Who is not on the group yet? Yes. Now, all the notes we'll be talking about compiled. The notes are all here. Advantages, cost centers. Please make up your notes from this. And then, which one? Yeah, yesterday and today. But then the question bank. Okay, so now look at this question one. Is it clear to everyone? Right? Divisionalized structures are normal in large firms and occur even when centralized structures will be feasible. Requirement: explain and discuss the argument for divisionalized structure in a large firm. What do you think they're asking? Explain and discuss the argument for divisionalized structure. What do you think they are? Advantages, right? Explain the cost and potential inefficiencies of division. You're doing well. Okay, so let me state this here. This A part, please, is an assignment for you. Jot it down now. This A part is an assignment. That's that first part. And then my interest is on, let's go to this question. Okay, so we'll come to this 5. Look at question 6. Are we all there, everyone? Okay. Let's look at it together. The name of the question is what? Biscuit division, division B, and the cake division, division C, are 2 divisions of a large manufacturing company, right? While both divisions operate in almost identical markets, each division operates separately as an investment center. You can only have two centers now. Is that how you're having a profit center or you're having what? An investment center. I told us yesterday that it's difficult to have a center that solely costs or revenue. Why? Because of the company. I explained that. All right. Each month, operating statement must be prepared by each division, and these are used as a basis for performance measurement for the division. Last month, senior management decided to charge head office costs to the divisions. Consequently, each division is now going to be required to deduct a share of head office costs in its operating statement before arriving at net profit, which is then used to calculate return on investment. Here are the power example. Now, if you want to appraise the manager, what kind of profit do you use? The 405, which is also what now? Controllable. Is it not controllable? Meaning that it should be profit that they can control. Now look at what they are saying here. Last month, senior management decided to charge what? Head office cost. Head office cost, it means that they are charging it to their profit statement. Is it within their control? No, right? Would it be fair to them charging this head office cost before arriving at the net profit? Now, what they are saying is that instead of using profit before interest and tax, what they are going to be using is what now? Net. Look at it. Before arriving at net profit, which is then used to calculate return on investment. Now, look at before this, they are nonsense. Look at what they said. Prior to this, ROI has been calculated using what? Controllable profit only, which is the ideal thing to be done, right? The company's target ROI, however, remains unchanged at how many percent? 20% per annum. For each of the last 3 months, division B and C have maintained ROIs of 22 and 23% per annum, respectively. It means they've been cashing out, they've been meeting up with their bonuses and all that, right? But remember, they were using controllable profit. But now, head office has seen that it looks like these guys are making too much money. Now, let's start charging head office costs into their profit statement. What's the impact of that? It will reduce their what? Their profit. When profit reduces, what happens to the RoCE? RoCE will do what? Will reduce. If RoCE reduces, it means that it's possible that they may not be able to meet up with what? Release their target. Right? Okay, so resulting in healthy bonuses being awarded to staff. The company has a cost of capital of how many percent? 10%. Now they've solved this work for the profit. The budgeted operating statement for the month of what? July. Take note. Month of July is shown below. Can you see sales? All figures suspended to 3 zeros. Sales, variable cost, contribution, controllable fixed cost, controllable profit, blah, 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 head office, apportion cost. And then you have divisional net asset. You have the net profit, 311. Look at the requirement. What are we asked to do first? Calculate the expected what? Annualized return on investment using the new method as prepared by senior management based on their own projected. What is the expected performance? Now, the same we should calculate expected annualized return based on what? What is the new method? That's what I'm going to ask. The one they are charging head office cost, which means we are going to be using the net profit. All right, so let's quickly do this. No thinking. A part of the question. It's on the group already. Biscuit and Cake division, Abi. The A part of the question asks us to calculate what? Calculation of, remember, annualized return on investment, Abi. So our ROI equals to net profit divided by the net assets multiplied by 100 all over 1. Now, can you remember what RoCE is? Remember in RoCE, you have profit before interest and tax divided by what? Divided by capital employed. Is that not? The same thing is applicable to ROI. Ideally, your ROI should be profit before interest and tax divided by maybe capital employed or the net asset or the investment cost, right? But now they said we should use what? Net profit, and that's why we are using net profit. Let me put in bracket. Using net profit. So we have two divisions. The first division is what? Division B, Abby? Division B. And then we have division what? Division C. So their July net profit. What's the net profit for July? Anybody?
$311.
Look at it here. Net profit for July is how much? 311. Remember, they gave us for only 1 month, but the question is asking us to do what? To calculate the annualized. It means you have to multiply by what? 12. So what do we have? 311 multiplied by what? 12, right? What do we have? Figure 3732. I buy for division B. What's your net profit? 292 multiplied by 12. Figure 3504. You're doing well. Next is to calculate what? Net assets, right? What's the net asset? That's 23,200. We are suspending 3 zeros. I hope you all understand that. Yes. And for this guy is how much? Division C is what? 22,600. So we can get our annualized ROI. So this guy will be 3732 divided by what? 23,200 times what? 100 over 1. And this guy will be how much? 3504 divide 22,600 multiply by 100 over 1. Help me. 16%, just 16, round figure. Okay, 16%. And this guy?
13%.
13?
13%.
15? Okay, so let's do one decimal. This one is 16 point what? Remember, their target is how much? Target ROI, how much? 20%. Have they done well? Okay. Based on the computations above, using the new method, net profit, both divisions did not meet the set target of how much? Of 20%. Why do you think they are not meeting up with the target? Anybody? Why do you think they are not meeting up with the target? Yes. Yes, exactly. This may be due to the head office costs being charged to the divisions before arriving at net profit. No further write-up is required. All right. Yes. Yes. You know, you never talk anything. Eh? Eh? Even if they do not ask you, as a professional, you should talk about it. Even if you are not asked. Yes, why not? Your examiner, ICANN is actually very easy. If you write ACCA, for those that will be writing ACCA after now, you appreciate the difference. You know, if you're writing ICANN, they can pardon a lot of things. But ACCA, if you're writing like one line, you see like 3-4 requirements, you need to read in between to be able to know what and what they're actually asking you to do. You know, but they can forgive a lot of things. Okay, so can we quickly do the residual income? Residual income. Remember, residual income. Now let's look at the requirements so we don't derail from. The first one, they say calculate the expected annualized return on investment. I mean, we have done that, which is the A part. I mean, and then the B part said divisional manager director are happy about the result produced by your calculation in A, and I've heard that a performance measure called residual income may provide more information. Calculate annualized residual income for each division based on net profit figure for July, right? So we are doing the B part now. So the B part of this question, residual income, remember it has to also be what? Annualized. Annualized. And our RI equals to what? In this case, now instead of profit before interest and tax, we'll be using what now? Net profit. Perfect. Net profit minus, instead of capital employed, we'll be using net assets now. Net asset multiplied by what? Weighted average cost. All right. So now let's compute. This is division B, and this is division what? Division C. First, let's get their net profit. Net profit, we already analyzed this net profit from here, same figure. Is that not? 3732. 3732, and this guy is how much? 3504, right? 3504. Remember, figures in thousand, figures in thousand. So we have your net asset. Net asset. This is 23,200, Abby. 23,200, and this guy is what? 22,600. 22,600, and then we have their WACC given 10% up here. 10%. No thinking. Let's plow on the figures into the formula. So our residual income for this guy, division B, net asset is 3732 minus 23,200 multiplied by what? 10%. And for this guy, it should be 3,504 minus 22,600 multiplied by 10%. If you are there, say I'm here. If you are not, say wait for me. Voila. 3,504 minus 22,600 times 10%. If you have a good calculator, please help me. What's the residual income? Figure. Figure. Oh yeah. Eh? 1412, like this. And this one. Eh? 1244, like this. We are done. Now, because of time, let me show us something that you go home and battle with. Yes. But there's nothing serious. Now look at, we have done this B part now, Abi. Now look at this C. Discuss the expected performance. Discuss the expected performance of each of the two divisions using both ROI and RI and making any additional calculations deemed necessary. Conclude as to whether, in your opinion, the two divisions are performing well. What do you think would be the expected performance? Anybody? What would be the expected performance from everything we're discussing? The use of controllable profits, all right? Is that what you expected? Your ROI and your RoCE expected you should use controllable profit. Now the first one, they use net profit. Now they're asking you now to discuss what the expected performance should be. That discussion, basically what you are talking about is that the use of net profit is not fair. Why? Because managers should be appraised based on what? The portion of profit and the asset that they can work, that they can control, and that's traceable to them. And then you should do what? Any additional calculation deemed necessary. So that means you go back to that statement. Look at the statement we have here. Yeah, I'm done. Yeah. What's the statement? Can you see head office cost here? How much is the head office cost? 155. So what are we supposed to do to this? So is either you're adding it back to this, or you're picking this controllable profit. So you are using controllable profit to recalculate your RoCE or ROI and then the residual. Do you understand ourselves? I'm talking to myself now. We have done the net profit. When we did net profit, we used what? 311 net profit. And we said it's not ideal because we should appraise them based on what they can control and is traceable to them. Now they said you should explain and also calculate what you think the ideal performance should be. In that case, we are no longer using net profit. What are we using now? Controllable. Where's the controllable profit? Yes. In some exams, they won't call it controllable. All you need to do is whatever thing that they try to head off, add it back to the net profit, it takes you to the controllable profit, and then analyze it and do everything else. Is that clear to you? Before our next class is your passport to entry. See you guys when we see.